Welcome to AM Best Audio.
Collateralized loan obligations have become a growing area of interest for insurers seeking yield and portfolio diversification. For insurers, the advantage of CLOs include capital efficiency to credit risk diversification. I'm John Weber for Best Review Magazine. I'm speaking today to Melissa Ricco, co-head of Barings' Structured Credit Investment Team. Melissa, so glad you could join us today.
Glad to be here. Thanks for having me.
So, Melissa, what exactly are collateralized loan obligations?
A CLO is an actively managed securitized product backed by a highly diversified pool of leveraged loans. CLOs provide an efficient, scalable way to invest in floating rate loans while offering structural protection that have historically performed well through multiple credit cycles. CLOs have been around since the 1990s and have now matured into a market worth more than $1.3 trillion with an actively traded secondary market.
Now, CLOs have been one of the fastest growing asset classes for insurance companies in recent years. Why is that?
CLOs offer diversification by providing exposure to a broad range of leveraged loans, typically involving 150 to 250 borrowers and across 15 to 20 industries. This diversity helps mitigate risk as the performance of the CLO is not overly dependent on any single borrower. Additionally, the structural features of CLOs provide further risk mitigation by redirecting cash flows from lower-rated tranches to more senior-rated tranches if the underlying portfolio's credit quality weakens. There's never been a default of a AAA-rated tranche CLO in its 30-year-plus history, and defaults in the rest of the capital stack have been relatively minor compared to their corporate counterparts. And lastly, the perceived complexity and a liquidity premium of the asset class offers the potential for higher spreads on a like-for-like basis in credit rating and regulatory capital. Due to many of these factors, CLOs have been one of the fastest growing asset classes for insurance companies in recent years.
How do regulatory changes impact the investment in CLOs by insurance companies?
Regulatory changes, particularly those from the National Association of Insurance Commissioners, NAIC, can significantly impact CLO investments by insurance companies. For instance, recent NAIC initiatives have aimed to revise capital requirements for CLO investments, potentially altering the risk-based capital or RBC factors for these assets, depending on what part of the capital stack an investor is in. This, of course, could affect the demand for CLO investments, making it crucial for insurers to stay informed and adapt their strategies accordingly.
What does it take to win in this asset class?
I would highlight three main tenets to win, and that is partnering with an experienced team that has strong access to the market and a commitment to underwriting. Teams with long, consistent track records across multiple market cycles are well positioned to navigate different market conditions. And given the complexity and specialization of CLOs, a dedicated team is key to capitalizing on opportunities in the asset class. Secondly, managers with long-standing and active participation in the CLO ecosystem can often negotiate favorable terms for their clients, including allocations to coveted new issue, CLO tranches, early first looks at primary and secondary market investment opportunities, and strong trade execution. And lastly, yet very important, is an effective CLO manager should employ rigorous bottom-up fundamental credit analysis. And CLO teams with investment managers that have a broad public and private fixed income team can leverage the firm's wider research and market insights. For CLO tranche investors, it is crucial to have the resources and capabilities to qualitatively and quantitatively assess each CLO collateral manager, the underlying portfolios, and the structural nuances of each CLO to better understand how they impact the quality and relative value of potential investments.
Melissa, how do you view the opportunity in CLO tranches for insurance investors today?
The opportunity in CLO tranches for insurance investors remain compelling due to attractive return potential, structural protections, and capital efficiency, especially for investment-grade CLO tranches. Despite regulatory changes and market volatility, the active management and structural protections inherent in CLOs can provide investors with attractive risk-adjusted returns. Insurers with access to experienced CLO investment managers with robust underwriting capabilities are well positioned to capitalize on these opportunities. The size of our team allows us to be nimble and invest where market opportunities arise. If we look 6 months ago, the primary market was more attractive due to higher spread levels and higher quality underlying portfolios. However, after the past few weeks of tariff-induced volatility, risk-remote AAA and AA rated tranches in the secondary market look attractive given their position at the top of the capital structure and high potential carry-on offer. Additionally, for buy and hold investors at various times, we find the private credit CLO market can also offer compelling spread pickup compared to the more traditionally broadly syndicated loan CLO counterpart. In summary, the dynamic and ever-evolving CLO market offers insurance investors the chance to achieve attractive risk-adjusted returns when guided by a skilled and experienced manager.
Melissa, so glad you could speak with us today.
Thanks so much.
That was Melissa Ricco, co-head of Barings' Structured Credit Investment Team. And I'm John Weber for Best Review Magazine.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.